As the labor market continues to trend in the right direction and stocks remain resilient, our first guest is raising his S&P 500 year-end price target. Let's bring in Brian Belski, BMO Capital Markets Chief Investment Strategist, joining us here in studio.
Oh, Kiko. Yahoo.
Good to have you here in studio. Let's start with that target. We're raising your target from 4,300 to 4,550.
Yep. So we had three scenarios coming into this year, okay? A base case, a bull case, and a bear case. And so our base case was 4,300, our bull case was 4,800, and our bear case was 3,600, okay? So we raised our price targets by 250 points across the board because the cost of equity is down, equity risk premium down, inflation down. So we believe the worst case scenario in terms of the Fed and inflation has already played out. Or has not played out, I'm sorry. So therefore, we have to adjust accordingly. That's number one. Number two, we're not changing anything on our earnings number because we think most investors are looking to 2024 anyway, and nobody really knows what 2024 earnings are going to be like. But we've seen a massive, you used the term resilience before, we've seen massive amounts of resilience in corporate earnings so far this year. So we think our 220 number's pretty good. But we do actually see earnings accelerating in the fourth quarter and then into next year. But we'll get to that while we get to that. Now, the next question you're going to ask is, at 45.50 and 220, that's a 20 multiple, Brian. Isn't that expensive? Well, if you go back and look at history, and it's something that we warn people coming out of a bear market, the average multiple increase for 12 months following a bear market is 6 multiple points. 6 multiple points. So multiples go up, okay, because earnings are low, multiples, and stocks lead earnings, which lead the economy. And that's exactly what we're seeing. And so we still believe that we're in a big, giant 20 to 25-year bull market. We're not being stubborn. We've been accused of that because you can have negative and flat years, like we had a negative year last year, and we were wrong, and humbly, we lost people money, but we've been right 9 out of the last 10 years. And remember, 7 out of 10 years, markets are positive. So we'll take that math. But I do believe that the worst is behind us. The Fed maybe has one more interest rate increase between now and the end of the year, and that's okay. But I think most of that has been already priced into the market.
Brian, where does the Fed stand in its fight against inflation right now? Because you make a point in your note that inflation, we are seeing some positive momentum in terms of it easing right now, but we're still at pretty high levels compared to where the Fed would like it to be.
Well, BMO has learned. BMO has learned that we're going to have higher interest rates for longer. Anything is higher than zero. That's number one, okay? Mm-hmm. Number two, in terms of the 2% target that the Fed is targeting with respect to inflation, we still need to have some work to get there. And Canada rose interest rates yesterday by 25 basis points because we've seen some more higher food inflation there. So are we going to have a little bit higher inflation this time around next week when we see CPI, PPI? I don't know. I do think the Fed probably has one more 25 basis point. For us, the way we look at things, it'd almost be better, Shauna and Akiko, if they raised interest rates by 25 basis points one more time, because I think it would be a lot worse for the market to pause, and then later this year, all of a sudden they come back and go, inflation's coming back, because then you have the rhetoric with respect to, this is the 70s again, and the Fed is wrong, and then I think that would really cause a stir in the market.
So get the hike out of the way next week.
I think so, and I do think that the bond market's kind of telling you that. I think the high is in for the 10-year Treasury, which is good news because that'll be good for mortgage rates. But I think people are missing that the home building stocks have been outperforming. And home building stocks have been outperforming. That's a leading indicator for the stickier part of inflation, which is the services side, meaning rentals and housing and things like that. So if we had more supply on that, I think that's going to be really good.
What about the odds of a recession, the odds of a soft landing at this point? It sounds like maybe that is still in the cards.
Soft landing, no landing, obsession, recession. We're obsessed with it. We're going through all the hits. You are an obsession, if you like the 80s music. Listen, the stock market was down 27% peak to trough, right? And so the stock market, when it's down more than 20%, tells you that portends to a recession down the road. So it almost doesn't matter. I don't know if you know this or not, but you don't invest in the economy, you invest in the stock market. So the stock market's already said, hey, we're going to have some sort of recession. Mm-hmm. My bet is this. I bet within the next 12 to 18 months, the ECRI, or all those smart people in the economic world, would come out and say, hey, by the way, we had a recession and it was in the third and fourth quarter of 2022.
Liking all these impersonations. This is an impersonation.
This is just really like serious. So, but no, I'm sorry. I don't mean to be flippant about it, but I think we're worried about the end game versus living our life, right? So stocks lead earnings, which lead the economy. The earnings have held in a lot better than everybody thinks. The economy is still strong. I mean, you think about, go back 2 weekends ago, Disney had its 5th highest opening ever on a weekend, right? For Little Mermaid. We're still going to the movie theater. We're still spending money. I'm jumping on a plane this afternoon. There's no seats. There's no hotel rooms. It's not just in New York City, but it's everywhere. So people are still spending money. They may be not spending $150 at Lulu, but they're still spending $100. And that's a good thing.
Let's talk about your investment thesis and what you're liking right now. The tech sector, clearly seeing some of the big gains here, up more than 30% on the year. You are overweight on the sector. Is it all about AI?
No, it's not. And thanks for bringing that up. And by the way, it's the first time we've been overweight since 2019. And that's a big call for us because at that point, heading into the end of 2019 into 2020, tech was about 30% of the market, and I don't like when a sector is 30% of the market. That's why our weighting's 29. That's number one. Number two, we've had three different tech markets so far this year. January was the January effect rally, meaning the worst performing stocks in 2022 were the best performing stocks in January. January and February, we had more of a value move. Then we had the bank, quote unquote, debacle. I'm not going to call it a crisis because it wasn't a crisis, okay? And you had investors sell their financials and buy tech. That's tech move number two. Tech move number three, I think, is the real move, and that is AI. I think AI is here to stay. It's built in efficiencies. I think you need to look at AI like you would any other emerging technology in another sector. For instance, in healthcare, you want to buy the big healthcare companies because they'll end up buying or finding the drug or the biotech that's actually going to work, right? Or in energy, you want to buy alternative energy. You want focus on alternative energy. Buy Chevron and Exxon because they're going to be the ones that are going to invest the most in alternative energy. It always works that way. So what does that mean for tech? I think it's Apple, Microsoft, the Google machine, Netflix. Those types of names. But also, we've owned core positions in NVIDIA and AMD because they're the best companies in that space anyway. So I think you want to barbell semiconductors. On this side, you have NVIDIA and AMD, and on this side, you have Broadcom and Qualcomm. You kind of balance out the higher multiple with the lower multiple.
Spreading around some of the fears out there that maybe this rally that we have seen in AI is overdone at this point. Brian, what about healthcare? Because you also changed your positioning there, your outlook for that sector, downgrading it to market.
Yeah, there's been a bit of thanks for bringing it up. There's been a bit of a COVID hangover, I'll call it. And we always like healthcare. We buy companies that keep us alive. That's kind of our thesis. Aside from United Healthcare. It's true.
I like that. It's a good investment.
United Healthcare is an amazing company throwing off lots of cash and great dividends. It's been one of our core positions for 11 years that we've been managing money at BMO. But I think some of these healthcare stocks get above their skis a little bit, and they've had a little bit of problems with growth. So we like the biotech sector for cash, actually, and value. There's some really great value there. And some of the drug companies, and a company like Thermo Fisher was just a juggernaut in terms of instrumentation. So we've just tightened up our positions there a little bit. Remember, people forget that healthcare is the second largest sector in the United States. Second largest. So you have to be really careful in there. I think you have to be much more stock picking. I think the other big thing that people are missing in the market, Sean, if I have a second, is small cap, small mid cap. I think we've had a generational opportunity to buy small cap thanks to the banking debacle. I think they threw the baby out with the bathwater with respect to small caps, and they've created this great and amazing buying opportunity. As the market broadens out, small caps with respect to cash flow, balance sheets, and earnings discernibility are the best I've seen in 30 years. And I think that's very, very good for the United States market.
So get in now.
Get in now.
Okay. Brian Belski, BMO Capital Markets Chief Investment Strategist. Have a safe flight back.
Thank you.
I hope it's not too crowded.
It will be. That's okay.
Got to come back and visit us soon there, Brian.